Imagine building a bank from the ground up. The technology, the physical branches, even the products, and all while you're trying to clean up this legacy portfolio you inherited.
Oh, yeah.
That's a challenge.
It's a huge challenge.
And that's exactly what IDFC First Bank is doing, and that's the story that we're going to unpack today in this deep dive.
Yeah.
We're going to be going into their second quarter of fiscal year 25 earnings call transcript.
Okay.
Really getting into this conversation between the bank's leaders and these financial analysts.
Interesting.
Our mission today is to help you understand where this bank stands today, what hurdles they're tackling, and what their plan is for the future.
Well, the thing that strikes me right away is the deposit growth. It's impressive. I mean, they hit 2.18 lakh crore rupees, but they're offering lower interest rates than their competitors.
So what's the draw for customers then? I mean, are people just drawn to these sleek new branches?
Well, it's more than just the aesthetics. The CEO actually repeatedly emphasizes this customer-centric approach during the call, highlighting things like personalized financial advice and a really smooth digital onboarding experience.
Yeah.
So it sounds like they're going beyond just chasing high deposit numbers.
Yeah.
And they're trying to build these lasting customer relationships.
Okay, that makes sense. But does that strategy actually work? I mean, do we see that translating into any concrete financial benefits for the bank?
Well, one good indicator is their CASA ratio. It's currently upwards of 48%.
Okay.
And a high CSAR ratio, that means they've got a strong and stable deposit base, which is made up of current and savings accounts.
Okay.
Now, that's crucial for any bank that's aiming for long-term profitability.
Right, so that's the deposit side of things. What about their lending activities?
Yeah.
Because I know that they've been pushing pretty hard on both the retail and corporate fronts.
Yes, they have. And they've achieved really robust growth in both of those segments. Retail loans have grown by 25%.
Wow.
And their corporate lending, excluding infrastructure, has increased by 20%.
That's really good.
And the growth isn't coming at the cost of recklessness either. Their asset quality remains strong, with a retail gross NPA of just 1.57%.
Okay.
So they're clearly managing risk effectively.
That's impressive. But I did notice that the transcript also mentions some trouble spots, particularly in their microfinance portfolio. It sounds like they're facing the same headwinds as a lot of other banks are in that sector.
Yeah, they are. And the CEO doesn't shy away from acknowledging those challenges. They have seen increased delinquencies in this area, and they've had to set aside a pretty hefty 315 crore rupee contingency provision.
Wow.
However, the CEO also claims that their underwriting process is more robust than their competitors.
Okay.
And he points to their strong performance in these other lending segments.
I see.
It's a little bit of a mixed bag. There's some concern, but also a degree of confidence.
So are they just talking a big game to kind of reassure investors, or is there actually evidence in this transcript to back up this claim of superior underwriting?
Well, there are a few things that do stand out. First, they are being proactive by taking a conservative provisioning policy for their microfinance segment.
Okay.
So they're already providing for 80% of the book on a 90 DPD basis, essentially preparing for potential losses early on.
So it's kind of like battening down the hatches before the storm hits.
Exactly. And they've also taken the step of securing insurance for their microfinance book through CGFMU,
Okay.
which should offer some protection against further losses.
That's a good move, especially given how volatile the microfinance landscape is right now.
Yeah.
But I'm curious about something. Those steps might mitigate losses, but do they actually point to superior underwriting compared to other banks that are facing similar challenges?
That's a fair question, and honestly, the evidence is more suggestive than conclusive. They point to their low credit costs in other segments, like their home loans and even their credit cards, as a sign of good risk management. But whether that actually translates over to their microfinance portfolio is something we're going to have to monitor.
Okay, speaking of things to monitor, the unexpected hit from that toll road project really highlights that even these seasoned lenders can be caught off guard.
Oh, absolutely. That 250 crore rupee hit was a stark reminder that infrastructure lending can really be a wild card.
Yeah.
You're at the mercy of external forces, like regulatory changes, or, in this case, a state government's decision to waive toll fees.
Right.
It's a stark reminder of how important diversification is.
It sounds like they were totally blindsided by that decision. How are they addressing this now?
Well, they've taken a 100% provision against that legacy toll account, essentially writing it off entirely.
Okay.
Now, while this will definitely impact their short-term profitability, it's a decisive move and shows they're committed to transparency and maintaining a healthy balance sheet.
So they're cleaning up the mess and moving on.
Yeah, it seems so. And while those challenges with microfinance and infrastructure lending are definitely concerning, It's important to remember that their core business actually seems to be performing quite well. Their net interest income is up 21% year on year, and their net interest margin is holding steady at 6.18%.
So they're weathering the storm.
Yeah, it appears that way. Their core operating profit is showing impressive growth, up 28% year on year.
So even with these provisions impacting their bottom line this quarter, the fundamentals of their business appear to remain strong.
Yeah.
But will investors have the patience to see this through?
Well, that's the million-dollar question. The CEO articulated a pretty bold vision, projecting a 6 lakh crore rupee deposit base by fiscal year 29.
Wow.
But that implies a significant acceleration in their current growth trajectory.
Do you think that's a realistic target, or is that just CEO optimism talking?
It's certainly ambitious,
Yeah.
but their recent track record does suggest that they have the potential to attract deposits at a rapid pace.
So what will it take for them to reach that goal? What are the key things that we should be watching for in these coming quarters?
Well, their success really hinges on flawless execution of their strategy. And that means continued expansion of their branch network, enhancing their digital offerings, and most importantly, maintaining that laser focus on service as a differentiator.
It sounds like they've got their work cut out for them.
They do.
But before we dive into those specifics, let's take a closer look at their cost of funds, something the CEO seemed particularly proud of during this call.
Yeah, it's understandable why he'd be pleased. They've managed to bring their cost of funds down to 6.3%,
Okay.
which is a significant reduction from their post-merger level of 7.8%.
Yeah.
This is a testament to their success in building a stable and diversified deposit base.
So a lower cost of funds translates into what exactly for someone like you or me?
It means they can lend at more attractive rates while maintaining healthy margins. Think of it like this. If you're borrowing money at a low rate, you can turn around and lend it out at a slightly higher rate, and you pocket the difference as profit.
Okay.
It's a fundamental driver of profitability in banking.
I'm starting to see how this all fits together.
Yeah.
But is there any room for further improvement, or have they squeezed as much juice as they can out of that lemon?
Well, there's always room for optimization. The CFO did mention that they expect further reductions in their cost of funds as they continue to pay down their higher-cost legacy borrowings.
So as those older, more expensive debts roll off,
Right.
it should naturally bring down their average cost of borrowing.
Exactly. And this is a key area to watch going forward. Even small reductions in their cost of funds can have a really significant impact on their bottom line, especially as their loan book continues to grow.
Now, on the flip side of the coin, let's talk about their lending rates. It sounds like they're trying to walk this tightrope,
Yeah.
aiming for a healthy net interest margin, currently at 6.18%,
Uh-huh.
while facing pressure from regulators to lower rates, particularly in that microfinance segment.
It's a balancing act that a lot of banks face. They need to attract borrowers with these competitive rates, but not so low that it eats into their profitability.
Right. How are they navigating this challenge? Because it sounds like they're getting squeezed from both sides.
Well, they've already reduced their microfinance lending rates,
Yeah.
and they'll likely continue to adjust their pricing in other segments as needed. But they're also determined to maintain a healthy INEM, which is crucial for their profitability.
So they're playing this delicate game of finding that sweet spot.
Yeah.
It'll be interesting to see how they handle this pressure moving forward.
Uh-huh.
But before we get into what lies ahead, there's one more piece of the puzzle. We need to look at their cost-to-income ratio.
Yeah, this is definitely an area where they're lagging behind some of their peers.
Okay.
Their cost-to-income ratio currently stands at 71%, which is a bit high.
Is that cause for concern? What's driving this higher ratio?
Well, the CEO addressed this directly. He attributed it to the significant investments that they've made in building the bank over the past 5 years.
Okay.
Things like expanding their branch network, developing new products, and upgrading their technology infrastructure. It's a classic case of short-term pain for long-term gain.
So they're making the investments they think are necessary to be competitive in the long run, but it is impacting their profitability in the short term.
Exactly.
Does the transcript offer any insight into when those investments might start to pay off?
The CEO expressed confidence that their cost-to-income ratio will come down over time as those investments start to yield returns and their business scales up.
So it's a matter of time and execution, but will investors have the patience to wait?
That's always the question, isn't it?
Yeah.
They need to demonstrate tangible progress on this front in the coming quarters. They need to prove to investors that these investments are going to ultimately translate into greater efficiency and profitability.
Speaking of demonstrating progress, we can't ignore the elephant in the room, the recent merger with IDFC Limited.
Yeah.
This was finalized at the beginning of October, just after the earnings call that we're analyzing.
Right.
Now it's a major development, simplifying their corporate structure and potentially unlocking some synergies between the two entities.
Yeah.
The CEO didn't really delve into the details during the call, but he did mention they expect a capital adequacy benefit of about 24 basis points as a result of this merger. What does that mean for someone like me who doesn't speak fluent finance?
Essentially, it means that the merger will strengthen their capital position, giving them a larger buffer to support future growth and absorb potential shocks. Think of it like having a bigger safety net.
Okay, that sounds like a positive step.
Yeah.
But mergers can be messy. Are there any hints in the transcript about how they're managing this transition?
Not really, but it's definitely something to keep an eye on. A smooth integration is going to be crucial for realizing the full potential of this merger.
All right, so we've covered a lot of ground. We've looked at their impressive deposit growth, their strong lending performance, the challenges in microfinance and infrastructure, and even their recent merger.
Yeah.
But one question keeps coming back to me. How are they managing risk, especially given all of these bumps in the road?
Well, the CEO emphasized their commitment to maintaining a clean and transparent balance sheet and their willingness to take provisions early when they see signs of potential trouble.
That's a prudent approach, but is it enough? Do they actually have the systems in place to identify and mitigate those risks before they become major problems?
Well, the CEO highlighted the robustness of their credit underwriting process
Okay.
and pointed to their track record in other lending segments like home loans and even credit cards
Yeah.
as evidence of its effectiveness.
Uh-huh.
They've managed to maintain low credit costs in those areas, which is notable considering the industry-wide challenges.
So they're learning from their experiences and applying those lessons to manage risk across their entire loan portfolio.
Yeah.
It sounds like they're taking risk management seriously.
They are, and this focus is going to be crucial as they continue to grow and expand into new areas of lending.
Now, before we wrap up this part of our deep dive, I want to highlight one more thing that really struck me during this call: the CEO's optimism. Despite the challenges they faced, he genuinely believes they're building something special. He even used the phrase, a really great bank in the making.
Yeah.
That's a bold statement.
It is.
Does the transcript offer any clues as to where this confidence comes from? Is it justified, or is this just wishful thinking?
Well, there are a few factors that might explain his optimism.
Okay.
First, their core business is performing well. Their net interest income and operating profits are both showing strong growth.
Okay.
They've also managed to significantly reduce their cost of funds and maintain good asset quality.
So it's not just blind faith. There are tangible signs of progress.
Exactly. And then there's the merger with IDFC Limited, which has the potential to create significant value and strengthen their capital position.
It sounds like there's a lot to be optimistic about.
Yeah.
But there are also risks and challenges ahead.
Of course.
So what does this all mean for you, the listener?
It means that IDFC First Bank's story is a complex one, full of potential, but also with some areas of concern. They've made significant progress, but there are still hurdles to overcome.
We've examined the facts, we've analyzed the challenges, and considered the potential, but ultimately it's up to you to decide what this information means for you.
Consider the risks and the potential rewards. Weigh the CEO's optimism against the realities of the market. And most importantly, do your own research to form your own informed opinion.
In the next part of our deep dive, we'll delve deeper into some of the specifics of their financial performance and explore their strategy for achieving those ambitious growth goals.
Sounds good. Welcome back. Last time we were talking about IDFC First Bank's cost-to-income ratio and their efforts to bring that down.
Right.
And, it's worth remembering that this is a bank that's essentially been built from scratch over the past 5 years.
Yeah.
And all those upfront investments in branches and technology and new products, they're going to weigh on their efficiency in the short term.
It's like building a house. You've got to pour the foundation before you can start decorating.
Exactly.
But that doesn't mean we should just ignore this issue entirely.
Right.
What are some specific actions that they're taking to improve this cost-to-income ratio?
Well, one key lever they're pulling is increasing the proportion of low-cost deposits,
Okay.
which we touched on earlier with their CISA ratio.
Right.
By attracting more customers to their current and savings accounts, they're reducing their reliance on those higher-cost funding sources,
Okay.
which ultimately improves their overall profitability.
So it's not just about growing deposits, it's about attracting the right kind of deposits.
Exactly. And they're also working on streamlining their operations, optimizing their branch network, and leveraging technology to automate processes.
Okay.
Think of it like fine-tuning a machine to make it run more efficiently.
I like that analogy. So let's shift gears a little bit and dig into their growth strategy.
Okay.
Because the CEO mentioned this ambitious goal of reaching a 6 lakh crore rupee deposit base by fiscal year 29.
Yeah.
What does that kind of growth actually look like in practice?
It means they need to significantly expand their customer base, both in terms of individuals and businesses,
Okay.
and this involves attracting new customers while also deepening relationships with their existing ones.
So it's not just about getting more people in the door, it's about getting those people to stick around and use more of their services.
Precisely. And their strategy seems to be centered around three key pillars.
Okay.
Expanding their physical branch network,
Okay.
especially in underpenetrated regions, enhancing their digital offerings to provide a seamless and user-friendly experience, and maintaining their relentless focus on customer service as a key differentiator.
I am curious about this focus on physical branches, though, because in this increasingly digital world, is that really the best use of resources?
That's a good question. And the answer might really depend on the specific market that they're targeting.
Okay.
While digital banking is undeniably on the rise, there are still segments of the population, especially in rural areas, that prefer that face-to-face interaction.
Right. So it's about striking the right balance between that physical and digital presence.
Exactly. And they seem to be aware of this because they're also investing heavily in their digital capabilities.
Okay.
They've already made some strides in this area. Their mobile app is receiving positive reviews for its user-friendliness.
But a slick app isn't enough to guarantee success, right? What about the competition? How do they plan to actually stand out in such a crowded market?
That's where their focus on customer service comes in.
Oh.
They're trying to create this differentiated experience by offering personalized financial advice, streamlined processes, and a genuine commitment to building those long-term relationships.
So it's like the human touch in this digital world.
Yeah, I think that's a good way to put it. It's about combining the convenience and efficiency of digital banking with the personalized touch of a traditional bank.
It'll be interesting to see if they can pull that off.
Yeah.
But let's circle back to their lending activities for a moment.
Good.
They've achieved some pretty impressive growth in both retail and corporate loans, but we also discussed those challenges in microfinance and infrastructure.
Right.
So how do these different pieces actually fit together in their overall lending strategy?
They're aiming for a balanced portfolio with a mix of secured and unsecured loans and exposure to various sectors of the economy.
Okay.
So this diversification helps them to manage risk.
So it's about not putting all their eggs in one basket.
Exactly. And their focus on retail lending, which tends to be less volatile than corporate lending, provides a really solid foundation for their portfolio.
But they're not shying away from corporate lending either, right? I mean, they've seen healthy growth in that area, excluding infrastructure.
That's right. They're being cautious with infrastructure projects after that toll road setback, but they still see opportunities in other areas of corporate lending.
Now, one thing that struck me while I was reading through the transcript was the CEO's emphasis on maintaining a clean and transparent balance sheet.
Yeah.
What does that actually mean in practical terms?
It means being upfront about potential problems, taking provisions early on when necessary, and ensuring that their financial statements accurately reflect the true health of the bank.
So no hiding bad news under the rug.
It's exactly. It's about building trust with investors and regulators by being open and honest about their financial position.
But transparency can be a double-edged sword, right?
Yeah.
If you're too open about your problems, could that scare away potential investors?
It is a risk, but
Okay.
I think in the long run, transparency is the best policy. Investors are more likely to trust a bank that's upfront about its challenges than one that tries to sweep things under the rug.
That makes sense. Now, let's turn our attention to a topic that came up kind of towards the end of the call.
Okay.
The CEO's philosophy of being a karmayogi.
Yeah.
He used this term to describe the dedication and hard work of his team.
Right.
It's a bit unusual to hear this kind of language in a corporate setting.
It is.
What do you make of it?
It's certainly not your typical corporate jargon. Karma yogi is a concept rooted in Hindu philosophy,
Okay.
referring to someone who performs their duties selflessly without attachment to the fruits of their labor.
So it's about doing good work for its own sake, not just for the paycheck or the promotion.
Yeah, and it's about having that long-term perspective, focusing on building something lasting and impactful.
I can see how that philosophy might resonate with a team that's building a bank from the ground up.
Yeah.
It's a massive undertaking that requires a lot of dedication and a belief in the bigger picture. But how do you translate that philosophy into tangible actions?
It's about creating a culture of excellence where people are motivated by a sense of purpose and a desire to make a positive impact. It's about encouraging collaboration, innovation, and a commitment to continuous improvement.
So it sounds like they're trying to build more than just a bank. They're trying to build a community, a shared mission.
Yeah, and I think that's a really powerful idea. It's about aligning everyone around a common goal and creating that sense of ownership and pride in their work.
It's an inspiring vision, but the cynic in me wonders if it's just window dressing, a nice story to tell investors.
Yeah.
What's the evidence that this Karmayogi spirit is actually translating into tangible results?
Well, it's still early days,
Yeah.
but there are some signs that this philosophy is taking root. Their employee satisfaction scores are reportedly quite high, and they've been recognized for their innovative products and customer service initiatives.
Okay, so it's not just talk. There's some substance behind it.
It seems that way.
Right.
Of course, only time will tell if this philosophy is going to be sustainable as the bank grows and faces those new challenges.
That's a great point. Culture can be fragile, especially as organizations scale up.
Right.
But before we dive into what the future might hold for IDFC First Bank, let's take a step back and talk about something that often gets overlooked in these earnings calls:
Okay.
the role of regulation.
Right.
How is the regulatory landscape impacting their strategy and operations?
Well, the banking sector is heavily regulated, and for good reason.
Yeah.
Regulators play a crucial role in ensuring the stability of the financial system and protecting the interests of consumers.
So it's not just about profits and growth, it's about operating within the rules and meeting certain standards.
Absolutely. And IDFC First Bank, being a relatively new bank, is subject to even greater scrutiny from regulators.
Okay.
They need to demonstrate that they have robust risk management systems in place and that they're operating in a safe and sound manner.
That makes sense. But regulation can also be a burden, right? I mean, it can stifle innovation and make it harder for banks to compete.
Yeah, there's definitely a tension between regulation and innovation.
Right.
Regulators need to strike that balance between promoting stability and allowing for experimentation and new ideas.
So how is IDFC First Bank navigating this tension? Are they pushing back against regulations or are they embracing them?
They seem to be taking a pragmatic approach.
Okay.
They're engaging with regulators constructively, seeking clarification on rules, and adapting their operations to comply with the latest guidelines.
So they're playing by the rules, but also trying to shape those rules where possible.
Exactly. And they're also leveraging technology to improve their compliance processes and reduce that cost of regulatory burden.
That's a smart move. Another external factor that can significantly impact a bank's performance is the overall economic environment.
Yeah.
We're currently in this period of global uncertainty with rising inflation, supply chain disruptions, and all of these geopolitical tensions.
Right.
How are these macroeconomic headwinds affecting IDFC First Bank?
Like all banks, they're exposed to the broader economic climate. Slowdown in economic growth could lead to lower demand for loans, which would impact their revenue. Rising interest rates could also increase their cost of funds, squeezing their margins.
So they're not immune to these external forces.
No bank is.
Yeah.
But their focus on building a diversified loan portfolio and maintaining strong asset quality should help them weather the storm.
What are some of the specific steps they're taking to mitigate these risks?
Well, they're being more selective in their lending, focusing on borrowers with strong credit profiles and stable cash flows. They're also tightening their underwriting standards and increasing their provisioning levels to prepare for potential losses.
So they're battening down the hatches and preparing for a bumpy ride.
Yes, it seems so. They're also closely monitoring that macroeconomic environment and adjusting their strategy as needed.
That's reassuring. Now let's shift gears one more time
Okay.
and talk about something that's been looming large over the banking sector in recent years: the rise of fintech.
Yeah.
How is IDFC First Bank responding to the challenge posed by these nimble, tech-savvy startups?
They're embracing the fintech revolution,
Okay.
viewing it as an opportunity rather than a threat. They're partnering with fintech companies to offer innovative products and services, leveraging their technology expertise and customer reach.
So it's a case of, if you can't beat them, join them.
Exactly. And they're also investing heavily in their own digital capabilities, building a robust technology platform, and hiring top talent in areas like data analytics and artificial intelligence.
So it sounds like they're trying to have the best of both worlds:
Yeah.
the stability and reach of a traditional bank combined with the agility and innovation of a fintech.
Right.
But is that even possible? Aren't these two models fundamentally at odds with each other?
It's a challenging balancing act, but I do think it's possible to bridge that gap.
Okay.
It requires a willingness to embrace new technologies and business models while also maintaining a strong focus on risk management and regulatory compliance.
It's a fascinating dynamic to watch unfold.
Yeah, it is.
Now, before we move on to our final thoughts on IDFC First Bank, just one more area I want to explore.
Okay,
Their approach to corporate social responsibility.
right.
How is IDFC First Bank integrating social and environmental considerations into their business strategy?
Well, they're increasingly recognizing the importance of sustainability, both for their business and for society as a whole. They've made commitments to reduce their carbon footprint, promote financial inclusion, and support community development initiatives.
So it's not just about making money, it's about making a positive impact.
Exactly, and they're integrating these sustainability goals into their core operations rather than treating them as these separate initiatives.
Can you give us some specific examples of what they're doing?
Sure, they're financing renewable energy projects, providing microloans to women entrepreneurs, and supporting educational programs in underprivileged communities.
Okay, so it sounds like they're taking a holistic approach to sustainability, addressing environmental, social, and economic issues.
Yeah, and they're transparently reporting on their progress, which is crucial for building trust and accountability.
All right, so we've covered a lot of ground in this deep dive.
We have.
We've examined their financial performance, their growth strategy, their risk management approach, their corporate culture, and their sustainability initiatives.
Yeah, it's been a lot.
But now it's time to kind of bring it all together.
Okay.
What are your final thoughts on IDFC First Bank?
It's a bank that's still in its early stages of development, but they have made significant progress in a short period of time. They're ambitious, innovative, and committed to building a sustainable business.
But they're also facing some challenges, right?
Of course, the banking industry is inherently competitive and cyclical. They'll need to navigate economic headwinds, regulatory changes, and the evolving landscape of financial technology.
So it's a mixed bag with both opportunities and risks.
Exactly. But I think they have a strong foundation, a clear vision, and a dedicated team. It'll be fascinating to see how their story unfolds in the coming years.
What are the key things you'll be watching for in the future?
Well, I'll be monitoring their progress on improving their cost-to-income ratio, expanding their customer base, and managing their risk exposure, especially in those microfinance and infrastructure segments.
And what about their karma yogi philosophy? Do you think that will continue to guide their actions as they grow and evolve?
It's an interesting question. Maintaining a strong culture can be challenging as organizations scale up. It'll be interesting to see if they can preserve this sense of purpose and dedication as they navigate the complexities of the banking industry.
Well, we've certainly given our listeners a lot to think about.
We have.
But before we wrap up this deep dive, I want to remind everyone that this is just one perspective.
Right.
We encourage you to do your own research, read the transcript of the earnings, call yourself, and form your own informed opinion about IDFC First Bank.
Investing is a personal decision, and it's important to consider your own financial goals and risk tolerance.
In the next and final part of our deep dive, we'll recap the key takeaways and leave you with some parting thoughts on what the future might hold for IDFC First Bank. Stay tuned. Welcome back to our deep dive into IDFC First Bank's second quarter fiscal year 25 earnings call. We've covered a lot of ground from their deposit growth and their lending decisions to their karma yogi philosophy and those challenges that they face in a rapidly changing industry.
Yeah, it has been quite a journey, and now it's time to kind of synthesize everything that we've learned
Right.
and extract some key takeaways for our listeners.
So let's start with the big picture.
Hmm?
What's the overarching narrative of IDFC First Bank's story at this point in time?
Well, it's a story of ambition, resilience, and this relentless pursuit of growth. I mean, they're building a bank from scratch.
Right.
And that comes with its own set of challenges and opportunities.
They've made some pretty impressive strides in attracting deposits and expanding their loan book and really building a strong foundation for future growth.
They have, but they've also faced some setbacks,
Right.
particularly in their microfinance and infrastructure lending portfolios.
Yeah.
I mean, they're operating in a volatile environment, and they'll need to navigate those challenges very carefully.
Absolutely. So what stands out to you as their most significant strengths?
Well, their focus on customer service is a major differentiator. They're really trying to create that personalized banking experience, even as they scale up. And they're also investing pretty heavily in technology, which is crucial in today's digital world.
And what about their weaknesses? What are some areas where they need to improve?
Well, their cost-to-income ratio is still high, which reflects those significant investments that they made in building the bank.
Right.